All right. Will public or private markets shape the future of global investment? Now, before we discuss this, we have to be very careful. Because I know the panelists are all going to devolve to the lowest common denominator. Will public or private markets shape the future of global investment? You're all going to say, no, it's not one, it's the other. We need both. We need a bit of, aren't you? Mary,
probably.
aren't you? Mary you're CEO of Asset and Wealth Management at JP Morgan. That's what you're going to tell me. It's not one, it's not the other, it's both.
But it is.
Well, then we'll just go back and have a cup of tea. What's the challenge with that? By the way, we've also got Roger Crandall of MassMutual, Bill Ford of General Atlantic, Dame Julia Hoggett of the London Stock Exchange, Julia. We have Ken Moelis of Moelis & Co. and Tong, the chairman of the Hong Kong exchanges, Hong Kong. So, accepting that you're all going to tell me it's a bit of both, let's start with where you think the primary investment opportunity lies.
Well, the primary investment opportunity, as we all know, is still the public markets. And that's the most liquid, deepest access to companies all around the world. But just let's ground ourselves in what's happened to the US public markets as a for instance. There used to be 7,300 public companies back at the height in 1996, and today there's 4,300. So we've dropped by 40% over the course of 30 years. In the meantime, private equity has grown sixfold over the course of 20 years, and private credit has grown fivefold in the course of just 10 years. So you have a complete shift in the things that are available to invest in. And the question is, do you have access to invest in those markets? Is it appropriate for you to invest in those markets? And can you sustain any periods of illiquidity, because you're sacrificing liquidity in order to get access to these markets, which can provide great returns if done in the right hands, but you have to make sure you can weather through those times.
When you look at that, Bill, that number, that dramatic shift in the reduction of number of public companies, what do you take from it?
I think it's concerning because it is the primary source of opportunity for investors is to be in the public markets, despite the growth in the private markets. But just, I wanted to pick on one thing that Mary said that I think is important, is this point about liquidity, illiquidity. The public markets offer liquidity, and that's why we need it, and investors need it. And the private markets need to offer excess return or alpha to justify the illiquidity that they have. And we've always thought you need 400, 500, 600 basis points of premium performance to justify the illiquidity in the private markets. And that's what we've tried to do. I think the asset class has delivered that, and it's why, as Mary said, we've seen significant growth. But we absolutely need a public market because it's not a replacement for it, the private markets.
So what is the difference, in your view, in the duties that each provides?
Well, I think in the case of private markets, it's really what generates alpha. And I think it comes from industry insight, deal acumen, company building skills. And it's the firms in that area that have to apply those skills and get them ready to be public companies on the London Stock Exchange, the Hong Kong Stock Exchange, and then be available to a broader set of investors, institutions and retail investors. So that's really the job of the private markets.
Well, I want to say, first of all, I went public 10 years ago. I was a private company. Probably this, we were talking about it before. I said this is probably the single greatest day of my life. There's nothing that demonstrates capitalism like watching your stock open on the New York Stock Exchange, liquidity. I brought my family, my kids. It was the greatest day in their lives. So I just, all the entrepreneurs out here are thinking about it and are being told it's terrible. It's fantastic, number one. But number two, what's happened that Mary was talking about, we have all these agencies now that are trying to tell you how to run your company. ISS tells me who I can have on my board. So there's how I can get compensated. You have to go to consultants. So you go private and you have all this dynamic opportunity. I think that we've regulated the public market out of existence, 7,000 down to 4,000, because who wants ISS telling you who your directors should be and what age they have to be and what your disclosure has to be? I think I have a mine safety disclosure. We're an investment bank. I have to disclose our mine safety procedures. It's not really relevant, I mean, for those who ever worked in an investment bank. So these outside influences that are over-regulating the public markets are squeezing the life out of them.
So you haven't decided to go private?
The trouble is I love being public. It is...
Why?
Why? Instant access to liquidity. The markets, by the way, if you're running a company, I think the market speaks to you. You don't have to listen to it every day, but it'll tell you whether they like what you're doing and they don't like what you're doing. And by the way, as a group, they're smart. The general market has an influence, and they'll let you know whether they think you're on the right track. And it's good information to have. It's really, I think it's good input.
So we've only been private for 173 years. And we're owned by our policyholders. And I have no interest in going public whatsoever.
How often does the debate come up?
Zero. Right? Because the alignment of interests with the long-term nature of our policyholders is so great compared to stockholders who may have a short-term desire. 0.5% of extra interest in our bond portfolio by investing in illiquid private bonds is worth 40% more in accumulated value after someone's lifetime. Mm-hmm. That's a great thing, and we can do that because we're matching illiquid assets with illiquid liabilities. So there's a place for private companies for the long term as well, and from an investment perspective, a lot of lending is done by private companies. So we're largely talking about this in the context of equities, and I agree being public is great. And I think the ability for ordinary people to own the greatest companies in the world in small amounts is an amazing triumph of capitalism. But we love being a private company for the long term.
But Bill needs both. Bill needs to be able to find the private company and then be able to take it public in the public markets for liquidity.
Right, so we have beaten up on both of you, or at least they have. You're old-fashioned, you're sclerotic, you're over-regulated, and there's far too much. Julia, why are they wrong?
To me with that, thank you.
Well, we'll come to you next. But
No.
Julia, why are they wrong?
Well, I think that there are certain points I absolutely agree with Ken on, actually, which is we've had a mindset, I think, in the UK that we have sought to so protect people from the downside that we haven't exposed them to the upside. And one of the challenges in regulating kind of one regulation for every different investment scenario is that you wind up everybody being in the same bucket or being constrained by the same things. The simple reality is that we need a world, and I'm afraid it is answering both sides of your question, that enables private companies to thrive and that entrepreneurship and that curation and that company building to happen, and to happen in the way that is the best to coach a CEO as to how to build a consequential company. But we then need to make sure they've got numerous courses of exit. Now, one of the things I care about, I chair a task force for the UK that has a very simple vision statement. How do we create the best possible environment in the UK for great companies to start here, grow here, scale here, and stay here? Now, to do that, you need private and public. We have incentivized all of our institutions to buy public and less incentivized them to buy private, which is why, I mean, Bill's had great pickings, but it's why we've not had as much of our private money coming in. In order to actually solve that, you need to think differently about the problem statement. It isn't about, I think, CEOs of exchanges going, boo, hiss, private markets are bad. What we've done at the London Stock Exchange is set ourselves a very simple target. We want to be the first exchange in the world that is genuinely indifferent as to whether a company is public or private.
You want to be? Mm-hmm. So you're not yet?
Well, I need the regulation to go through in the summer of next year.
Oh, the regulation. We'll come to you in just one second. Yes, sir. She's going to be the first, by the way.
All right. Oh, good. Now, being the chairman of the Hong Kong Stock Exchange, which is the public market in Hong Kong, you will think that I'm slightly biased. I'll be forgiven to be slightly biased towards public markets, right?
Well, I would hope so, since you're running one.
Yes, that's right. And I think you probably have to ask yourself, why is that the private markets has grown so much? I think it's the low interest rate environment, the abundance of liquidity, and also the desire to seek high return. I think those are the major reasons why the private markets has gone so strong. But let's look at what are the difference between the private market and the public market. The public market has got far more stakeholders. So I think the public markets have to answer to regulators, to shareholders, to community, to employees. So that's a big difference between the two.
But yes and no. Yes, go ahead.
No, I just was going to jump in because that's exactly right. But the reality is that if you don't have to look at your portfolio every day, every hour, because you're not in need of making a decision of needing liquidity. You're much better off in private equity holdings or private credit holdings that don't have day-to-day mark-to-market values. You will make better long-term decisions.
When you say you will make...
You, the investor.
Right, but what sort of investor? Are we talking institutional, pension fund? Are you talking...
Today, it's everybody. Today, it's everybody. We have a term called AIQP, okay, which allows smaller investors to be able to invest in private equity, private credit, anything private. That rule was established back in the 1980s, and it said you had to have $200,000 US dollars of income or $1 million of net worth. That rule hasn't changed since the 80s. Inflation adjusted, that's now a $3 million, $500,000, but that hasn't changed. So all you need is the $200,000 in income and $1 million in net worth, and you can access these markets, which will probably allow you to make better long-term decisions for a portion of your portfolio that you shouldn't have to want to sell every day.
How many of your your clients would you say take advantage of investing in?
Well, we try and get as many as possible who can sustain the fact that they can't have access to 100% of their portfolio on a daily basis if they don't need it, because it's better for them long term.
What sort of differential of gains have you seen between those investments?
Well, it's what Bill said. First, you take away the liquidity premium you're paying.
Right.
So call that 100 basis points, 200 basis points, depends on the market. And then you find someone in this room who will manage your private investments in a very smart way, and they will add alpha, and it can be 200 basis points in a bad year, it can be 500 basis points in a good year, and now you're talking real compounded returns, and that's why the stakeholders at the end of the insurance policies are getting so much more in their balances, which allows them to retire better. And that's, at the end of the day, every asset manager's goal is to make sure that the end amount of money that the person has is better with them than had it been done on their own, which people usually make human decisions, and they tend to sell at the wrong time and buy at the wrong time.
Surely not.
Oftentimes.
I find that hard to believe.
I just want to tie something that Mary said to what Ken said, and that we've watched over many, many years, which is the 7,000 companies to 4,000. I think it is tied to overregulation. It's why companies are choosing not to go public, and they're waiting to a much higher level of valuation to go public. And now that opens up the private markets for us. We've got more opportunity to invest in high-quality private companies because they're waiting longer to go public. We still want and need the public markets because we need to deliver liquidity ultimately for our investors, Mary's clients. But they're waiting a lot longer to get there because of, again, the regulatory point.
Yeah. And look, this is the rationale for the strategic reset that we've taken at the exchange. But I think it is an important thing. When you're looking at that delta of 7,000 to 4,000, the public markets have to ask themselves that question. They have to ask themselves, what have they done when they had all of that right ingredients, all the ingredients Ken was going into, and they still have a huge number of them. But I think the question is, the public markets have to look at themselves and go, what is my value?
That's you.
Well, I don't write most of the regulations for most of the public markets, but that's exactly what we are doing in the UK. So we're looking at everything from our listing rules, the demands on corporate governance, the demands on disclosure, the risk appetite in the country, and the creation of a crossover market. We're looking at all of those things to look at that reset. And I think it's an important debate to have. It sounds like an unusual thing for the CEO of an exchange to say, but I think we have to look at ourselves and say the world and the global economy works best when you have a very synchronistic relationship between the private and public markets. Each play their part, but the public markets have to make sure they are something that can take and are attractive to those private companies that Bill's curating.
I think what you have to ask yourself is that, what's the purpose of the market? Is it just shareholders' return? Or should we consider other societal benefits? Because the market is obviously to allow companies to have access to funding, to market variation, to liquidity. But I mean, I would like to ask, does CEO have a greater responsibility more than shareholders' return?
So, hang on, you've taken us down a road,
yes,
which is a little... What would you suggest is the wider societal role of the public market outside of the narrow definition of the liquidity raising of companies?
That's correct.
So what is it?
What is it? It's inclusiveness,
Of what?
diversity.
Well, hang on, of what?
Roger said it before. It actually reinforces capitalism because when the public sees companies go from inception to growth, being public, and then the wide public being able to participate in that growth. Think Apple over 40 years of being public. The public's been able to participate in that. That reinforces the whole notion of free markets.
And Mary made the point, actually. It's a democratizing force. You know, the best way is people feel that they've got a stake, whether it's in your 401k or in a pension in the UK or wherever else, you've got a stake in the success in society. The definition in the US means that in private company investment, you don't quite yet for everybody.
Okay, so before I come to you again, I am old enough to remember Sid.
Yes, so am I.
Right? There'll be a couple of people here who will remember. Sid was part of the UK's privatisation in the 1980s under the Thatcher government. And I was British Telecom, I believe, that started it.
Tell Sid. British Gas and British Telecom, yeah.
Right. Sid was the one who was going to be there.
Psst, pass it along, tell Sid about buying these shares.
That's right. Now, that was the way, that was the way in which supposedly there was going to be the democratisation of shareholding in the UK. Did it work?
Well, I'll make possibly a Ken point again. I'm not calling them all regulation points, Ken points, but Sid would be illegal under the financial promotions regime in the UK nowadays. So that tells you something about how far we've come. I actually do think, yes, it had a big impact on giving people a sense that they could have a stake in companies. In certain jurisdictions, we have actually made it harder and harder for retail to participate in our markets. We've made it easier for them to access cryptocurrencies and harder for them to access things that are actually real economic assets. And so that is a question about how we make sure regulators get the balance right.
So you were saying about democratization. I think the big thing that's going on between public to private is credit. And it's the undemocratization of risk that's happening, and I think that's very good for society. So what the regulators have learned in the SVB, Credit Suisse, is that there already was $22 trillion of private credit. It was just all bank debt. But it was financed in the most ridiculous way. You had 5-year loans, and what we found out is we had 5-second liquidity. That's a bad system. You can remove your money in 5 seconds, and the bank had 5-year loans. And the intermediary of that, helping to leverage it 10-to-1, was the taxpayer, was the guarantee on FDIC deposits. This is what's leading to the boom in private credit, which is really the capital that you're talking about, is that if you could take this capital off of bank balance sheets, risky capital, take the taxpayer out of guaranteeing bad decision-making, which, by the way, seems to recur. It does not seem to be just Lehman and Bear. It seems to happen every 10 years. You find out that somebody's made horrific loans.
Well, S&L crisis, we've all been,
So the rise of private credit is an unbelievably good thing for markets, for societies. The individual now who makes the loan, maybe they're one-to-one leverage, but if an institution loses their money, fine. Get the taxpayer out of it, and I think you'll have a much better society.
I mean, I don't disagree with that. I think that public markets and private markets can coexist, and they need to compete with each other, because I think public companies can learn to improve themselves as well. And then I think regulators can learn from it, because I think there is a risk that you might over-regulate, and that's important.
Is there a feeling, Mary, that when it comes to private markets, even though pension funds and the like access in a sense, but there's a feeling with private equity, JV, all of these private things that the ordinary person's left out, that somehow it is those with money having access to those opportunities and funds, and guess what? They're all at it again.
That is how it used to be. It's changing. And the good news is that we have all these things that are providing more access for people to be able to put this in mutual funds. We can now put privates in up to 10% of mutual funds. We have evergreen funds that we can do, and now we're even starting to put them in ETFs, which are daily traded ETFs. And if we get what you're trying to do, which is be able to more liquefy the private markets on the LSE as a for instance, now you really bridge that gap where almost anyone can have that access.
That access, Roger, is crucial in a sense, because if the markets, public or private, are going to enjoy, for want of a better word, societal support, there has to be a feeling of entrance.
Yeah. So look, as the fixed income guy here who's kind of doing the lending, I kind of want to point out that capital getting from all around the world to bring to companies, in many cases smaller and mid-sized companies that have been the driver of job growth, for example, in the United States and around the world, is a very positive thing. And that incremental yield that starts with an institutional investor getting access to significant information. I have much more information about my private portfolio than I do about my public portfolio on the debt side, right? Because I can actually get monthly financials. I can talk to management. Might have covenants that provide protections but also help us monitor the business. That gets passed through to someone who's buying a $50,000 annuity at a JP Morgan branch, in New York, right? And gets them a higher yield. And that higher yield allows them to ultimately accumulate more money. So it's a very virtuous kind of cycle here. Again, I think when we talk about this, it's really important to remember that most lending is actually private lending. And this breadth of capital coming to these private markets actually makes a more resilient financial system, and that is a real positive.
But does Sid believe that Sid is getting a fair crack at the whip, or that though Sid being the individual investor who always feels, I mean, even, let's forget day traders and momentum trading and all that, just the ordinary person who sees their portfolio not going up by as much.
Boys, who's an investor in your life insurance?
Again, our 7 million policyholders
Right,
are very much ordinary folks.
They're
And again, today, through a variety of things, whether it's a perpetual interval fund that's offered to accredited investors, whether it's a business development company that's publicly traded, whether it's the opportunity, hopefully, to be able to buy smaller lots on an exchange like you're talking about, getting that access is really important. Does everybody feel like they're getting a fair shake? No one ever feels like they're getting a fair shake, right? That's just the way people are, right? But what's happening is we're actually connecting more people, and that's a positive thing.
But I think the way to connect this is going back to Sid till now. It's the great banks and the great insurance companies that have democratized access to private markets.
Right.
When Sid was around back then, you're right, there wasn't ways for the individual investor, even the high net worth investor, to access private market. That's changed dramatically. And again, it's really the banks and the insurance companies that have made that happen.
On the company front, I just want to talk to you, Julie, about this idea, which is relatively new, but you believe is going to become much more, and I was listening this morning to the CEO of Franklin saying the same thing. This idea of public companies moving between public and private and back to public again, depending upon their particular position of development. In the past, when a public company's gone private, we've always thought there was either something weird going on, a rich person's game going on, or it'll all end in tears.
Well, the logic for PISES, which stands for the Private Intermittent Securities and Capital Exchange System Regulation, but the R is silent.
Good, you shortened it.
Yeah, I know. But PISES basically provides the opportunity for a private company to have an auction of their secondary shares at a periodicity of their choosing. So it gives a transparent price formation process for angel and seed investors to get out. It gives the ability for institutions to start following companies prior to the IPO. It gives the ability for VCs and PEs to have another exit strategy that doesn't force a trade sale or an IPO based on their liquidity dynamics, not the strategic dynamics of the company. And it provides the opportunity, if the company wants to provide liquidity for staff. All of it can be done intermediated through advisors and banks and everybody else. So it's using the existing system, the existing pipes and plumbing, but it's designed to resolve the valley of death problem, but also to democratize that. But our view in the UK is the idea that a company could move up that scale or down that scale.
I could make an argument that would say a better solution is that investors grow up and realize that sometimes companies are beyond the quarterly reporting season. I mean, we were talking about this with AI earlier. Yeah. You know, everyone sort of says NVIDIA gently says, well, it might take a little bit longer than we originally thought. And everybody childishly falls out of bed.
Well, one of my visions, I have to say, for this ability to have a funding continuum is that you have institutional investors having to have that long-term view because they're now holding more of these private companies in their portfolio, seeing what consequential business building looks like through that lens, and learning to have patience in management before they become public. That doesn't mean everybody will, but it is a hope that you could shift that dynamic somewhat.
Is it workable?
Yes. In fact, let me, just where we're sitting. Aramco doing their IPO here, I think it was now 5 years ago, ignited the Tadawal, ignited a capital source for Saudi Arabia. I'm going to say something, but I'm not positive, but they might be the #2 IPO country in the world as of right now. By the way, given the way the US is, I wouldn't doubt that they're #1. But the amount of liquidity for growth, for capital, for families who've had, for family transition, to create growth capital inside the market. And it's on fire, by the way. We're activated, and the fact is you could see the local market wants to invest in regional companies that are doing great, and you can sense the positive reinforcement, the positive circular virtuous cycle going on. And this is what happens when you have an exciting market, high growth, and capital that needs to flow in, and businesses that want the capital for growth.
Ken's exactly right. So JP Morgan is highly involved in most of these IPOs around the world. And there used to be 100 a year. Back in 2021, there was 100 a year. 2022, there was 8. So this year, things are looking a little bit better, but there's only been 33. And
what do you attribute that to?
We're almost in November. It's a lot of what we've been talking about. There's stay private longer, if you can. The regulations, the activists, the quarterly obsession, all of that. If all else equal, you are a CEO, stay private a little bit longer until you're ready, as Ken was. He didn't go public right away. He waited until it was institutionalized, it was ready to go. And then you can sustain that. But until then, the markets are readjusting. And there are places like right here, where we're sitting in Saudi Arabia, where there's a lot of activity and it's in a different generation. And so you're seeing the excitement here, and this is exactly where the shift of focus has become.
What can be done to change the environment then? Start with you.
Well, I want to go right back to the regulatory side, because when I talk to CEOs, particularly of smaller and mid-sized companies, they say the cost of being public is high, and it's too high for the benefits I get. You know, the other is public markets are the crucible where fear and greed run into changing expectations. I love public markets, and I love volatility, because as a predominantly long-term private market investor, that breeds opportunity over time. Right, we just heard how in 2000 the internet bubble burst and companies fell 99%. That was a public market bubble and a crash, but guess what? What came was the best after that. So recognizing that fear and greed are going to be causing these kind of moves, public markets are always going to have these ins and outs. I'm very optimistic that the combination of the US election happening, the Fed ending the raising cycle at the short term of the curve, and reasonable valuations of public markets from both buyer and seller perspective, we could see a lot more activity in the next couple of years.
So as I finish, I have $1 million to give each of you. No, nothing to do with voting or registering. We wouldn't want to fall foul of that, would we?
No.
$1 million. You cannot split it up.
Uh-oh.
Oh, darn.
Oh, do you not think I didn't see that one coming? All right, all right. Bearing in mind our friends from exchanges, I'll allow you to do a percentage. What percentage public, what percentage private? $1 million, what percentage?
Tell me your investment objectives and your liquidity needs. Can't answer the question otherwise.
That's called pleading the fifth.
70-30.
Which way?
70 public and 30 private.
If you get the return, I think liquidity is, if you get the return, why not be liquid? So I'd say you have to demonstrate some excess return to be private, so I'd go mostly public.
I'd say put it on Pisces.
I think it depends on your risk appetite.
Oh, for goodness sake, getting a straightforward answer.
I'm a conservative investor, so I would invest on companies which I think are safer, give high dividend yield, etc.
The answer is exactly these two. Our average institutional pension fund, sovereign wealth fund allocation to privates is about 10 to 12%, and our large family office and ultra high net worth client is somewhere in the 30 to 35% range. Those are the two answers.
Ladies and gentlemen, practical advice from the best, our panel.
Thank you very much.